Good afternoon and welcome to Charting Points, a technical look at ag markets. Today is September 26th. It is a Tuesday. Just to give you a heads up, we normally produce these on Tuesday and Thursday. This Thursday, or for the balance of the week, we will be in some company meetings. And so therefore, we will not have a Charting Points on Thursday of this week. So after today, we will see you again on Tuesday of next week. Make sure you're keeping in touch with what is happening in the markets every morning as we send out our podcast at about 7:30, 7:45 Central, 6:30, 6:45 Mountain every day. So that's the best way to keep informed with the best amount or the most amount of information. But let's get into charting points here. First, we'll read our disclaimers. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability therefore is expressly disclaimed. Past results are not indicative of future results. Okay, thought I'd take a bit of a different approach today, just because I am flying out for these meetings pretty soon, so wanted to make it quick and simple. We're going to go through some charts here today. Relatively quiet day in the markets. Most of the markets finished the day off near unchanged, but just kind of wanted to update you on my thoughts around these charts. Now, here's corn. And what's interesting about corn is yesterday there was about a 1.6 million ton flash sale announced in corn, and that was a pretty big sale. It was 1 million tons for this 2023-24 crop year and 600,000 for the next crop year. That did rally markets yesterday a little bit up to the 20-day moving average. But you can see in the last couple of weeks that 20-day moving average has been a really big sticking point on the resistance side of this market. Even going back to the beginning of September, the 20-day moving average has been tough to maintain gains above. And, it's a declining moving average line as well. And the market continues to, the volatility is being compressed in this market as it trades in between kind of the previous low here or the August low, somewhere around 473, and then this 20-day moving average, which is currently trading at 480. So not a lot of volatility. We did see a couple of days in the middle of September that punched lower. So the low on this market now is 467 and 3/4. What we should really be doing is moving our support line down to there. But that previous low there of 473 does look like it's still acting as a bit of resistance, and maybe just a couple of blow-off days to the downside on the 17th and 18th, or 18th and 19th of September. So overall, I think this market is still trying to find a bit of a bottom. I think it does have the opportunity to continue to punch lower. All of these technicals that you see on this chart here are all kind of pointing towards lower, although the volatility has been reduced out of this market, so it might not be a stellar move lower. We used to call this death by 1,000 cuts, where the market would just kind of tick lower over time, and it didn't give a clear signal as to when a good time to exit would be or anything like that. So that's something to be aware of if you are not, or if you're positioned a little bit too long in this market than what you would like to be. Still nothing that shows that this corn market is completely out of the woods yet. Let's move on to wheat here. This is Chicago, and I think I touched on this on the last technical update. But there's kind of this stepped approach on the downside happening for Chicago wheat, as you can see, as it moved lower in the end of August and then again in the beginning of September. It seems to be trying to find a bottom here as well. Like corn, the 20-day moving average is also acting as some resistance up here. So what I'd want to watch for is a move below that low of 570. That would trigger possibly another move. We're seeing about 30, these steps are about 30 cents wide. So if we do break 570, we might be able to expect something in the 540 range as a test lower on Chicago wheat as well. I know there's lots of people who are saying that the wheat's too cheap and it has to go up now, but right now these market signals are not telling us that on the charts. Here is the the Kansas City. It's kind of also taking this stepped approach. Yesterday, we actually saw it move below the previous low there. It produced another new low of 703. Today, we saw some gains and they faded, and Kansas ended up at a loss, closing at 710, 710 and a half. So this could be a market where it still leaks lower into another step lower. As you can see, the range on here is, what would I call it here? Like 35 cents or so. So it's kind of similar to Chicago. So if we do break down below 710 again, we could be looking at a 680 type of step down on the Kansas as well. Again, not a lot of signals here that show us that this is a bottoming market. Minneapolis has been better than the other 3 week classes coming into this fall. And as you can see here, it hasn't really taken that stepped approach. It's kind of been more range bound through the end of August and all the way into the start of October here. It has moved above the 20-day a number of different times. I don't think the 20-day is as important here. What I do want to be aware of here is that, in the middle of the month, we did see the 50-day moving average cross below the 100-day. That is a bearish cross as well. So again, although I think the wheat markets are trying to find some bottoms here, there still is not a lot of technical reasons to take a very big, long bullish thesis on this commodity. Here's oats. This is an interesting one. Oats saw, almost 11 or 12% drop in value in the last few weeks. It came right down and tested support here of about 419, 420. The 100-day moving average was right there when it tested there as well. So a bit of a double test of support there, and it's come kind of bouncing back. Today was another one of those days where another one of these commodities where we saw it have some gains early in the day and they faded into the session. The high of today was 445. We closed it up at 433. So lots of volatility still in this market. As you can see here, the 20-day moving average, which was still higher than the rest of the moving averages at this point, is turned lower. It's aggressively moving lower while the 50-day is flattening out. I think we're probably going to see that cross there. So this oats market might be giving us a bit of a dead cat bounce here. That would be something to be wary of. I would be very concerned if this market started to break down below this previous low, which was 417 and 3/4. So that is a signal that some more value might get pulled out of this market yet. So it may have bottomed here. A bit of a double bottom happened here after the rally. Maybe that's supportive. Right now, the moving averages are a little bit mixed. So I would say that this is a very interesting chart. I think we will need to see some kind of directional bias on this play out before we can get either a strong feel one way or the other. I think it's a clearer signal if it breaks to new lows, though. So if it goes below 420, that's bearish. Can't really tell you where the technical bullish signal is on this yet, but that's just something to watch out for. Okay, as we get into the oil seeds, here's soybeans. We continue to trade right around $13 on the November. And it did test yesterday some of that support seen again from the beginning of August. So a bit of a double tap on that bottom. I would say that is the support we want to watch out for here. If it starts to break down below this low of 1282, I would start having some growing concern. We do have a bearish cross here of the 20 and 50-day moving average. 20-day, 50-day moving average crosses aren't necessarily long-term bearish. If it starts moving below some of these other moving averages, that might be a bigger signal that more weakness is to come. But as it says right now, we have a bit of a bullish bounce off of support at 1282. We have a bearish cross of the 50 and 20-day moving average here. So again, if it does, and now that we found this kind of bottom here temporarily or the last couple of days at around the 1280 mark, if it starts to break down below that, that would be a bearish signal. Right now, I'd be more neutral, but if it breaks down below that level, I would be turning my thesis towards bearish. Okay, moving on to canola. Canola, again, saw some larger gains in the session, faded them, but didn't fade them all the way back down to the previous lows. We did see kind of a double test of lows today at around 710. We have the 61.8% Fibonacci at 704. I did say that that's where I expected this market to kind of trade towards or magnet towards. If this market bottoms here, I would call that a test of 61.8. It's not that far away, just a couple of bucks away from there. But it's still possible that we'll see some weakness. The close today did showcase that, it's not a strong reversal here yet. We do have the 20-day coming down to challenge the 200-day. If that crosses, that would be a bit of a bearish cross that I'd want to watch out for. So overall, it's reached our canola within a few dollars has reached our downside target here now. There is, again, I've kind of been talking about some of these lows here down at 694, and then this one here at 685. It's possible that the market will go and try to test those again. I don't know. There's still a lot of risk in this market. I am not confident calling for a bottom on this market yet. Our sales recommendation is right at basically neutral at 50% marketed at this point. So we really are riding the fence hard on the canola market at this point in time. So much so that, we might be picking splinters out at some point, but that's just the way you have to position sometimes. And that's where we're at. So feel free to position yourself outside of our bias. I don't mind. My feelings aren't going to get hurt, but that's where I'm at right now is basically a 50-50. I'm at a 50-50 right now on the directional bias of the canola market. All right. I did want to talk a little bit today as well about some of the macro markets, and particularly, let's look at some of the stock markets today. And not that I think that there's a big correlation necessarily to indices and commodities, but the indices are really taking a hit in the last week. I think there is a really large bias towards risk off in these markets. I don't think the market had necessarily been expecting a lot of the hawkish information coming out of central banks, not only in the US, but elsewhere in the world. We're still seeing some inflationary pressures. And at this point, the cost of doing business in a high interest rate environment is starting to take its toll on business. And we're starting to see that play out in the equity markets. So you could see today, even, one of its largest days of losses here today, or at least, largest trading ranges that we've seen in the last little while, other than back on the 21st here earlier this week. We've seen a lot of volatility in this market. It is coming to test the 200-day moving average. If I was to put a Fibonacci retracement on this now, which I think would be appropriate, if we did it from these March lows, which kind of match these December lows over here, if you can see that, and, brought it up to the July highs, this market could still have a significant amount of downside. As you can see, the 61.8 brings it into this consolidation zone. So there's still a lot of loss that could happen in the equity markets here. All of these equity markets look very similar. S&P is, of course, your kind of Fortune 500 companies and those types of things. The NASDAQ is heavily weighted in tech. So you'd see your Apple and Google, Alphabet, Meta, whatever you want to call them. New lows posted in there as well today. I actually think that the low 14,805 was the low back in August. Yesterday was 14. Yeah, so we did see a new low posted yesterday, and the market expanded on that low today, bringing it down to 14,695 on the NASDAQ. The Dow, which is heavily weighted inside of industrials, so often seen as more reliable from an earnings standpoint, really took a hit. It is trading now below the 200-day moving average. So lots of risk in the equity markets. I think, again, that has to do with a large risk off tone, and I think that risk off tone is probably what would be detrimental to some degree to these ag markets. Sorry, I can't walk and chew gum at the same time, so I'm trying to scroll and talk at the same time. All right. One last thing I wanted to show you here was the U.S. 10-year Treasury note. This is the yield on that. It did reach a new high today at almost 4.6, 4.5. It's still trading 4.56. As you can see, there's a very well-defined channel occurring here. It's getting near the top of the channel, so it might be due for a correction here at some point. But if it does start to break out of this channel and into new highs, that I think would signal an even stronger push towards risk off, and it could introduce some risk. These are the types of things that we started to see ahead of, the financial crisis of 2008. Not that I'm comparing or saying that this is going to be, a deep cut like that, but it does feel reminiscent to that, where, the news is still publishing a relatively positive story, soft landing, talk about the economy, still good jobs, all of that stuff. But these treasury notes and the equity markets are starting to correct, which those are leading indicators of economic activity, not trailing indicators. So that's where we're at. I think the market is telling us that there might be more risk in some of the outside markets to ag. And I think if there is a risk-off tone, that might be where the risk of what we're seeing in the macro markets comes into play in the agriculture markets if we can't find a bottom on those ag markets pretty soon. All right, that's all we have for you today. Thank you, and we'll see you again next Tuesday. We will not be recording a charting points this Thursday. Thanks a lot. See you again.